Hi, everyone. Thank you for joining Wisdom Tree's office hours on Fed Watch with Professor Siegel. Powell and Co. go back to school, where you'll hear from Kevin Flanagan, Wisdom Tree's head of fixed income strategy, along with Professor Jeremy Siegel, Wisdom Tree's senior economist.
Thanks, Irene. Good afternoon, everybody. Professor, always a pleasure having you on, especially on Fed Day. I know this is probably one of your favorite days of the year. Eight
Yeah,
days a year, you get it, right?
yeah,
The
yeah. It's
Beatles,
marked up on my calendar. Nothing else is allowed this day. Uh, Afternoon.
the Beatles had 8 days a week. You have eight Fed meetings a year. That would have been
Right.
your top hit song. So, I don't know if there's really huge headlines out of the major story that you get. Yeah, as expected, the Fed cut rates a quarter point, marking to market, showing more concerns, obviously, on the employment side. We got the dot plots as well. So, without further ado, Professor, I'm just going to let you take
Yeah.
the baton and run with it.
Thank you, Kevin. All right. Well, so I look at the Dow. I mean, I'm sure S&P is similar. It's exactly where it was at 1:59 p.m., 1 minute before the announcement came out. Like we had a roller coaster, though. I mean, it was up 200, 250, down 200, and then ended unchanged. Bonds, a little different story. Went way down, now up, and yeah, up a few basis points on the day. So let's talk about it. Well, first of all, let me tell you why I think there was a big rally both in bonds and stocks. The median, this is what AI catches. The median said, "Oh, two more cuts." So that means a cut at each meeting. That's three cuts altogether for the fourth quarter. And someone said, "Oh wow, that's what we want." I mean, some people wanted 50. That wasn't going to happen, absolutely, with the retail sales coming in. But a lot of that was a headline. So all of a sudden, people said, "Oh my goodness, okay, we're going to be down 75 basis points. That's good, 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 good." Now, the interesting thing is, you look at the dot plot. Yes, that was the median. 9 people said we should have two more cuts. But 6 people said there should be no more cuts.
Yeah.
2 people said only one more, and one person said we shouldn't have had the cut we just had. So 9 people are on the other side of this. I'm taking out Steve Myron's big cut there because I kind of knew that was going to happen. So really, there's 9 that are very skeptical about this. Now, and I think that's sort of what the market. Ooh, wow! If the data comes in a little stronger, we're not going to get two more cuts. That is not going to happen. So I I think that the market reacted that way. Now, so let's talk about the bottom line and what's important. What's important is that there was only one dissent, a totally expected dissent by our new, Steve Myron, 50 basis. I mean, I would have given you 99-1 odds that was going to happen. And what is interesting is there were no other dissents. I thought there would be maybe one, maybe he would be joined by Waller on 50, and maybe there'd be a couple dissents of not going down. Clearly, there is one, or maybe it's Bowman, who said we shouldn't have had this cut, and yet did not dissent. I find that very curious. Someone who clearly on the dot plot said we should not have cut today and we should not cut in November or December, and yet did not dissent. Now, this is what I interpret this. I interpret this as a basic show of support for Powell and the independence of the Fed. Waller, maybe he shot himself in the foot if he wanted to be Fed governor. I'm not sure how Trump is going to say, why didn't you go for 50? But everybody, even those people who are skeptical, and I'm sure there were a few, said we're falling in line behind the chairman here. I thought that's interesting. A lot of people, and so you can interpret that as very positive, as support for the Fed and the independence of the Fed. So I think one should keep that in mind. Now, the next two cuts are not slam dunks, even though, very clearly that's the median estimate. Now, let's I was asked last week, I said, is there a chance for a 50? I said the only chance for a 50 today would have been a very weak retail sales report. Which, in fact, not only do we not have a weak retail sales report, we had a quite strong retail sales report. Let's face the facts. The facts are the consumer is not buckling. Now, retail sales is a bit lagged, but the high-frequency data, the anecdotal data, it's not that the consumer is, super strong. Certainly the high-end consumer is still buying with the stock market at all-time highs. There might be some more stress at the lower levels. That's maybe what, Scott Kirby, CEO of United Airlines says when he says, we're having no trouble filling the front cabin. It's the main cabin that we're trying to fill. But he did actually say bookings were strong overall on all cabins for the holidays. People are booking the holidays, and he does not see that slowdown. So, by the way, with the retail sales report, now Goldman Sachs, who I have tremendous respect for, as everyone should, I mean, their economic reports are really detailed and very good. They were the lowest GDP on the street. They were quite tariff fearful. They were not calling for a recession, although they were calling for the low ones for GDP this year. And the low ones in the third quarter, where they thought that would affect it. With the retail sales report, guess where they're at? I think they're at 2.4, 2.5. They jumped it from 1.9 from the one handle to the two handle, mid two handle. Now, it's not as strong as the St. Louis Fed that has, is now in the mid threes. It's always a little bit high on the St. Louis Fed. We'll see what comes up. But now, the most pessimistic man on the street, GS, is mid twos for this quarter. That's not a bad estimate for the first quarter. We all thought that the Trump tariffs would take a bite. Now, they might still take a bite into the Christmas season, where there's been a lot of talk by retailers that might be where we see some more bite. So I'm not saying the final story is written, but at least at this particular point, no bite. And in fact, the Fed updated its GDP forecast by merely 0.2, which might be too low at this particular juncture. So, I mean, what is the bottom line is, we are seeing some effect on inflation. I mean, Powell did talk about the goods component of the CPI moving up, which is affected by tariffs, but the other components are not moving up, and in fact moving down. Housing is still very, very weak. We've got another lower housing starts than expected. The NAHB number that came out earlier yesterday, I think it was also, and they're really rock bottom. But we are having some of the biggest drops in mortgage rates. Now, it's very important people understand what's going on with mortgage rates. Everyone says they think that the mortgage 30-year fixed is based on the 10-year. And yes, it certainly is important, but it's also based on the premium over the 10-year, which has been unusually high. I've talked about this. It's been unusually high because so many mortgage lenders were burned so much during the pandemic and the inflation that followed that they're building in big premiums. Now with the Fed on another downward cycle, these unusually high premiums, almost record high premiums, are beginning to disappear. That's why you actually see 30-year fixed mortgages down, 50, 60 basis points. The 10-year hasn't moved that much. Yes, maybe 10 or 15. But what you see is that premium going down. And that premium can go down still further. We can still have a mortgage drop with the 10-year staying at 4 to 410, which is good for housing, to say the least. So I'm just talking about that going forward. I think the basic, it's a basic story I think we should be 100 basis points lower. Do I agree with, Steve Myron that, we should do it all at once? No, that's not the modus operandi of the Fed. If they get down there by the beginning of next year, we'll get there. We might get a surprise next week. A week from Friday, there's some talk that the components of the PPI and CPI give a 0.2 of an increase in PCE deflator, which would be quite that's a 1/10 surprise, and you don't usually get surprises on that on the downside, which might really give the market. People say, buy the rumor, sell the news. This could be the peak. Now they started it. Everyone didn't want to sell before the cycle. Here's the cycle. It's a little ambiguous. We're ending the second half of September is a challenging seasonal period. I'm not going to say for sure it's going up during this period. I think the unity on the Fed, the start of the cycle, and the anecdotal and hard data real on the consumer hanging in there. And the fact that the jobless claim jump that we saw last week, which was worrisome. Now, tomorrow we will, of course, get another one, but it appears to be an anomaly in Texas, maybe connected with fraudulent claims. I don't know. That's been some of the data, and in fact, the street expects it down to 240. That's in the zone, the 200 to 240 zone. If it's 250, 255, I would get worried that this is a trend upward of layoffs. So we will see what basically does happen on those jobless claims. Again, consumer holding in, this market still goes up. The consumer not holding in, and then you get those layoffs, you're definitely going to get three declines, and maybe you need faster declines at that juncture. Everyone's just sort of waiting for that to happen. It just has not happened yet. And we'll see what kind of tariffs, and deals are getting negotiated. That seems to have slowed up. I don't hear a lot about it. I don't hear about what's going on with India exactly right now, what their stage of negotiation on tariffs are. There are talks that appear every few weeks with China. China telling NVIDIA, which dropped, I guess, significantly today, and we don't want your chips. We got chips that are just as good. They seem to be playing their cards pretty well on Trump tariffs. We'll see how India and Modi does and what Trump then decides to do ultimately on on the setting of these tariffs. We have some questions,
Yeah, so
Kevin.
Professor, it's interesting. We heard New York Fed President Williams characterize the employment setting no hire, no fire. Powell today called it low hire, low fire. So, looking ahead, to get the Fed to continue to cut rates in October and December, what kind of, you mentioned jobless claims. What about the monthly report? What kind of numbers do
Sure.
we need to see?
Yeah, obviously, well, we would, I would say 50 and below would guarantee a cut each one, and that could include a minus number. I mean, a big pause if we get over 100 on the plus side, considering the normal. Even 75 to 100 would put a lot of pause in it, also depending on what the inflation data is. I take a look at the sensitive. You also have to look at insensitive inflation data. I look at the Bloomberg Commodity Index, which is down 1.06% today. It's been really stable. Oil has inched up a little, but pretty stable. Look at those sensitive commodities. That's also an important index. Dollar was down originally again on 3 cuts, but I think the dollar index did come back, from what I understand, later in his press conference. But you look at sensitive commodities. The sensitive Goldman Sachs commodity index and the Bloomberg commodity indexes. Those sensitive commodity indexes are also very, very sensitive to what is going on. But I would say jobless claims that start, 245, 250, and numbers under 50 on that, which could include a negative. A negative number has a big psychological effect. If we get a negative payroll, we have not had a negative payroll, I think, since COVID, if I'm right. A negative payroll will hit the headlines because that's something that, oh my goodness, for the first time in 3 years, 4 years, whatever, we've lost jobs on a monthly basis. Just you can make that statement rather than there's a big difference between +5 and -5 here. But we'll see what happens on that and how well that consumer. There is certainly uncertainty and whether those tariffs begin to bite and consumers pull back or not. I think they should drop it again. I've mentioned this many times. To the extent that the tariffs cause inflation, and they do to some degree, that should not be a reason for the Fed to tighten or not be on a loosening path for credit.
Right. So on that note, it looks like Powell has finally come around to your thinking. I think we mentioned that when we did the Jackson Hole office hours as well in terms of tariffs impact on inflation. We've gotten a lot of inflation questions, so let's try to check off a lot of boxes with this one right here.
Okay.
We're getting to the point you mentioned before, it's the Christmas holiday shopping season, going to be here before you know it. Halloween decorations are all over the place already. So are we?
More than Halloween. I mean, I was in Sam's Club and Christmas trees are there. Halloween has been there for a month, Kevin.
I got to get out more, I guess. So when we're looking at the possible front loading, when imports surged earlier in the year, are you concerned we could get to a point where those inventories get drawn down and we see price pressures build a little bit going into the shopping season due to some shortages?
Yes. I there's some anecdote. I'm not an expert on that. I haven't read a report on that. I've heard some anecdote. I've heard some discussion by some people that have been that buy Christmas toys, ornaments, and paraphernalia, who've said they have just bought less because it's higher price and they don't think they're going to sell as much, and they actually think they're going to sell out. And if you don't get your stuff by like December 1st or 5th, you may not get a lot of the stuff you need. Now this is all anecdotal. I don't have any hard evidence of that. This may not materialize. I'm sure there's some retailers that are stocking it and will not release it until they see a shortage, and then it's going to be 30% higher in price to put your tinsel on your tree.
So another topic that has come up, and Powell actually addressed it today. I guess it was towards the end, and I guess it was because of Myron's comment about the quote unquote third mandate.
Yeah, very confusing. It was actually, if you want some history, it was actually Alan Greenspan who, when those three mandates came out, he was the one who said, well, we're going to subsume the moderate long-term interest rates under the inflation mandate, because if inflation under control, if inflation is 2 to 3%, you're not going to get 10% long-term interest rates, and that's true, and and interest when the current Fed laws on mandates, and I think that's the mid-70s, was written. I mean, that's when we were having a lot of inflation and interest rates were going to 10% and more. So everyone was concerned about those interest rates, and that's why it was put in. And then he made the statement, if I can control inflation, I'll control interest rates. And that has been, de facto the statement of the so-called dual mandate of the Federal Reserve, over the last 30 years, 40 years.
So would you have any concerns from the names you've seen so far for the next Fed chair that the Fed wouldn't?
Well, I don't, I think either Waller or Marsh, are Warsh, excuse me, Waller or Warsh, are the best. So Chris Waller or Kevin Warsh. I think Kevin Hassett, who is currently special advisor and was CEA, a very good man, just not a specialty on monetary theory and policy. I hear he's looking at Bullard. I hear he's talking to Rick Ryder. I mean, right from the financial markets, who I have a lot of respect for. I mean, these are very good people. I think it's part of Trump's thing. Keep everyone in the mix. No one's a certainty. Don't ever, narrow your choices until you have to. He did make a statement that's very soon. He might make an announcement within right after this meeting. Maybe he was waiting for this meeting before he makes an announcement. He did intimate, if I recall, that he was going to make an announcement soon. Whether that materializes or not, I do not know.
So we've gotten also a couple of questions. I think I know the answer to it. And you've kind of answered it to some extent, but do you think recession is ruled out now going forward, or the probabilities are just very low?
The probabilities are very low. Right now, I would say the probabilities look like background probabilities are always 15, 20%, and there always could be a geopolitical event or something, happening. But the tariffs just are not being applied. There's too many omissions. The tariffs are just not being applied on enough things, and they're being eaten by the exporters enough or by the importers enough that it just is not getting to the consumer in a degree that it would scare him or her to say, oh, my God, I can't afford anything. They're just not happening that way. Again, I mentioned for weeks and months that the 1 year expectations of the consumer of inflation were ridiculously high. I think, bloated by, the mainstream media, just talking about, tariffs, inflation, this could cost you this much and this much and this much, and it just hasn't happened. They're still high. and they're still greater than what. So those may not materialize and keep those consumers, in the game. Then again, if there's shortages and people see explicit things that are higher, anything on social media can blow up into something that, is much worse, and there could be panic buying on certain things. Toilet paper is up 20%. Buy as many as you can now before it goes up more. Who knows? I mean, so many things can happen that cause that sort of thing, but nothing like that has happened yet.
So we've seen the consumer, we've seen housing. What about business investment? There's something like that I think sometimes gets overlooked was some of the tax breaks on the R&D side that were in the one big beautiful bill. What are your thoughts on that as we move into 2026?
Well, the tax breaks are incredible. The ability to expense capital expenditures is a big plus, something that many of us have advocated for a long time. AI is still going very strong. Even, the AI doubters, the slow implementation, blah, 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 blah. That means more potential. Those are factors. That's, it's well known that the slowdown has been why GDP is low the first half of this year, and even this. Well, we'll see what consumption comes in. It's not going to be gangbusters third quarter. Is basically a consumer on a little lower, but business investment on the higher side. It's positive. It's positive long term for business investment, and it's a positive feature for the economy as a whole.
So, question coming in: money getting to put work now, cash. What should they be looking at in the equity arena? Mid cap, small cap, large cap, growth, value. Any thoughts there on your end?
Well, we did have again. The basic story is still the lower interest rates are basically help the small caps more and the smaller businesses more. I also have pointed out that that if the small companies start using AI meaningfully to cut their labor force to offset any higher costs that they might have, they may realize higher profits. So that's still there. But the AI, on Mag 7, they were a little weak today. Although, now that I look at it, Apple's up, Microsoft up, Tesla's up 1%. Netflix is up 2.3. I mean, you have a few things down. A big rally. It sold off a lot in midday after when Powell, said, oh, there's no talk of 50 basis points. All of a sudden, people say, oh my God, that's a real discouraging. And that's when you saw a tech plunge, and you saw the market plunge, and then people thought, well, what does that mean? They just don't want it right now, and so the market restabilized. Those sort of cuts still tied to that. I think really to have those small stocks do well, you need that sea change shift. It would really be helped by having a one in October 29th, I believe, and then the one in December. We should get 25 basis points each. Obviously, we would even get more had we see a real deterioration of the economy. They would definitely move faster. But at this particular point, we do not see that.
Which, time for one last question, and it's kind of a follow-up on that. The Fed is cutting rates in an environment where Powell described the economy as not being bad.
Yeah.
And that's a good thing, right? I mean, we don't want
Yes, we don't want rates because it's a recession. But it's slower growth. You should cut rates even if growth is slower, even if it's a supply side. There's a little confusion. I think one of the questioners has said, oh, well, if it's supply side, you can't do anything about it, but you should cut rates. In other words, if GDP is not growing as fast, and so far this year it's not growing as fast as last year, you should cut rates, even if the unemployment rate doesn't go up. I mean, the unemployment rate has actually inched up And we do have that kind of warning from the U6 unemployment, the minority unemployment, which is sometimes the first to be impacted. I got to look at that. And those were those warning signals that I think pushed Powell into saying, I see enough weakness there to continue. When we get September employment report, we should look again at the U6. Of course, we're going to have a couple of jobless claims beforehand to give us some pulse on the labor market.
Perfect. We're up 30 minutes here, Professor. Thank you again, as always, for your insights on Fed Day, October 29th. So right before Halloween, we'll get to see whether we get a trick or a treat, shall we say.
I like that, Kevin.
From Powell and Company. Professor, thanks again. Everybody, take care.